We're starting the year looking at the best ways to optimize your retirement, whether you're a young person saving up or you're nearing retirement age and want the best withdrawal strategies. Joining me now, we've got Robert Powell, host of the Decoding Retirement podcast. Bob, great to see you here. Happy New Year. I haven't seen you since the turning of the new year here. So how can we maximize tax efficiency when saving for retirement?
Yeah, so I think if you're lucky enough to have a health savings account at work, start there. It's triple tax advantage. Contributions reduce taxable income. The investments grow tax-free, and withdrawals for qualified medical expenses are tax-free as well. And then the next thing I would think about is look at your 401k. Is it a traditional or a Roth? If you have both options available, think about your tax rates now and what they'll be later. If you're in a low tax bracket now and you'll be in a high tax bracket later, contribute to your Roth first. And if you're a high tax bracket now and a low tax bracket later on, think about contributing to your traditional. The one caveat I would add to that, Brad, is this. Even if you're in a high tax bracket now and the bulk of your retirement money is in a pre-tax 401k, consider the Roth, because what you want to do is have what's called account diversification, money in your pre-tax account, money in your post-tax account, and money in your taxable accounts along the way.
Certainly. So for those approaching retirement, how can they withdraw safely without getting hit by a big tax bill?
Yeah, so this is a great question. Again, you have to be strategic about it. You have to think about your tax rates, not only now, but what they'll be over the course of your retirement. The traditional rule of thumb, Brad, is that you would take money from your taxable accounts first, then from your traditional pre-tax accounts like a 401k or an IRA, and then lastly from your post-tax account, your Roth IRA. And then along the way, if you have the opportunity, if the bulk of your money is, say, in a IRA, traditional IRA, start thinking about doing Roth conversions, because what you want to do is remove the taxable income from later in your retirement years when you could be pushed up into the 24% bracket or even higher. And then the last thing I mentioned taxable accounts. Married couples filing jointly can now realize up to $94,050 in long-term capital gains in this new year and pay no federal income tax on those gains. And that strategy can help, instead of tapping your Roth IRA account, it allows that Roth IRA to continue growing tax-free.
Really interesting. Bob, great retirement updates there. We appreciate it.